Okay, I want you to imagine waking up one morning, you pour your coffee, check the news, and find out that your entire country's financial system has just evaporated. Literally, completely wiped off the map. In less than a single week, the stock market crashes by 80%, the national currency loses half its value, and foreign governments are suddenly treating your homeland like a hostile threat. Now, this isn't the plot of some Hollywood financial thriller, and it's certainly not a hypothetical stress test. This is exactly what happened in the autumn of 2008. Welcome to This Explainer. Today we are unraveling one of the most astonishing, rapid financial disasters in modern history, the Icelandic banking collapse.
So let's dive right into this with a number that should honestly make your jaw drop: 11 times. To really wrap our heads around the sheer absurdity of this crisis, we have to look at the scale. By the summer of 2008, just 3 privately owned commercial banks in Iceland, Kaupthing, Landsbanki, and Glitnir, had accumulated total assets worth more than 11 times the gross domestic product of the entire nation. Just think about that for a second. If you applied that exact same ratio to the United States, it would be as if 3 banks held assets north of $250 trillion. It was an absolute empire built on leverage, completely defying all economic gravity.
Which brings us to the central mystery we're looking at today. How did a tiny island nation of roughly 300,000 people, a place traditionally known for fishing and, breathtaking glaciers, manage to effectively bankrupt itself in a matter of days? How did a financial system that looked so undeniably brilliant on paper suddenly trigger the largest systemic banking collapse in economic history, relative to the size of its economy? Well, to solve this, we actually have to go back a few years, to a time when everything seemed like an absolute fairy tale. Section 1. The Viking Outvasion. Look, if you were in Iceland in the early 2000s, you had absolutely no clue a storm was brewing. In fact, you were probably having the time of your life. The economy was booming, credit was flowing freely, and the national mood was just euphoric. It was the perfect setup to a financial boom that nobody thought would ever end. It all really kicked off around 2001 when Iceland's banks were deregulated and privatized. With this brand new freedom and ready access to unbelievably cheap credit in international money markets, these banks went on a massive global shopping spree. Between 2004 and 2005, the big 3 banks snapped up foreign assets worth an astounding 834 billion Icelandic kroner. We're talking retail chains, airlines, investment firms across Europe. And by 2006, they were launching wildly successful overseas operations, like Landsbanki's famous Icesave accounts over in the UK.
The national pride during this period was absolutely soaring. It was heavily coated in this almost invincible optimism. The media and the public even started referring to these bankers as brave Vikings raiding the world via acquiring businesses. It became a total cultural phenomenon. Bankers and the management class were suddenly spending this newly found wealth lavishly. Ordinary citizens were getting access to incredibly cheap financing to buy big homes and luxury cars. This tiny island had transformed overnight from a quiet fishing economy into a global financial juggernaut. And, from the inside looking out, it seemed like a perfectly engineered, unbreakable machine for endless wealth generation.
And honestly, nowhere was this success more visible than with Landsbanki's online branch, Icesave. They started aggressively marketing to everyday retail savers in the United Kingdom and a bit later the Netherlands. And how did they lure them in? By offering incredibly attractive interest rates of over 6%. That was far better than what any local British banks were offering at the time. And it worked perfectly. Over 300,000 UK customers deposited more than £4 billion into these accounts. Retail cash was just flooding into the Icelandic banking system, providing them with what looked like an infinite pool of liquidity.
Section 2. The Invisible Cracks.
But here's the catch. Behind the luxury cars, the massive corporate acquisitions, and the seemingly endless flow of deposit money, the foundation was silently rotting. The financial structures holding this entire 11x economy together were highly complex, incredibly leveraged, and dangerously fragile. Institutional investors started looking at this brilliantly terrifying financial mechanism, a credit default swap, or CDS. You can basically think of it like an insurance policy against a bank going bankrupt. Institutional investors, the truly smart money, were starting to look at Iceland's massive debt levels. They realized that if these banks couldn't roll over their short-term loans, they were going to fail. Period. So investors started buying up these credit default swaps to protect themselves. And the higher the perceived risk of the Icelandic banks collapsing, the more expensive it became to buy this insurance. Tracking this rising panic, we can see that as early as 2006, right after rating agencies like Fitch downgraded Iceland's outlook, the first real thunderbolt struck. The CDS spreads, meaning the cost of that insurance, started widening aggressively.
This was essentially the global debt market quietly whispering, "We don't believe you can survive." The banks were becoming stigmatized, and by 2008, the international debt market completely locked them out. No one would lend them the fresh cash they desperately needed to pay off their old, expiring loans.
Which brings us face to face with the terrifying mathematical reality of the situation. Take a look at these numbers. By 2008, the three major banks held foreign debt in excess of 50 billion euros. But Iceland's entire national GDP, that was only 8.5 billion euros. And the official reserves of the Central Bank of Iceland were sitting at just 1.2 billion pounds. Now, in a normal crisis, a struggling bank goes to its country's central bank for an emergency loan, right? They act as the lender of last resort. But Iceland's banks had grown so completely gargantuan that the Icelandic government couldn't possibly bail them out. It was like trying to put out a roaring forest fire with a garden hose. They were simply too big to save.
And the tension finally snaps in September 2008. When the U.S. investment bank Lehman Brothers goes bankrupt, it triggers an absolute global panic. The interbank loan market completely dries up. Banks everywhere just stop lending to each other out of sheer terror. For the Icelandic banks, which desperately relied on rolling over short-term foreign debt just to stay alive, this was a death sentence. Foreign lenders began issuing margin calls, demanding immediate collateral. And back in the UK, those panicked retail depositors started a modern-day bank run, frantically trying to pull their life savings out of Icesave.
Section 3. 3 days in October. With global credit completely frozen and billions of dollars draining from their accounts, the Icelandic banking empire finally reached its breaking point. Let's track this unprecedented freefall, because it happened so fast. On October 6th, the Icelandic parliament passes emergency legislation allowing the government to seize financial institutions. The very next day, October 7th, Landsbanki, the second largest bank and operator of Icesave, is taken over by the state. On October 8th, Glitnir, the third largest bank, is seized. And on October 9th, the final domino falls. Kaupthing, the biggest of them all, collapses. 3 massive, heavily leveraged banks totally wiped out in roughly 72 hours.
As one economics professor bluntly stated on national radio at the time, the Icelandic financial system is insolvent. The panic on the ground was absolute. The stock market was essentially wiped out, losing 80% of its value as soon as it eventually reopened. The Icelandic krona plummeted by 50% in a single week. Inflation spiked, millions of businesses faced ruin, and unemployment absolutely soared. For the citizens of Iceland, that beautiful Viking fairy tale had abruptly turned into a nightmare of debt and depreciation.
Section 4. The Icesave Standoff. Now, this wasn't just a domestic tragedy. It instantly became a bitter, high-stakes international war. Hundreds of thousands of foreign citizens had their money trapped inside the dead shell of Landsbanki's Icesave, and their governments were demanding answers. On one side of this standoff, you have Iceland. The government realizes they simply do not have the money to cover the billions in foreign deposits, and they flat out refuse to put that burden on their own taxpayers. On the other side, you have the United Kingdom. Furious that British savers are locked out of their accounts, the UK government takes a drastic step. They invoke the Anti-Terrorism, Crime and Security Act of 2001 to legally freeze all Icelandic banking assets in the UK. Yes, you heard that right. They used anti-terrorism legislation against a NATO ally to secure banking assets. It was unprecedented.
You can really hear the sheer desperation in the words of Iceland's Prime Minister at the time, Geir H. Haarde. Addressing his nation, he said, "There is a very real danger that the Icelandic economy could be sucked with the banks into the whirlpool, and the result could be national bankruptcy." He had to make an impossible choice. In order to save the sovereign nation of Iceland from literal ruin, he had to cut the cord and let the sprawling, bloated banking sector die. The nation's survival had to take precedence over saving the banks.
But across the ocean, UK Chancellor Alistair Darling was equally resolute. He stated, "We will take whatever action is necessary to protect British savers." The UK and the Netherlands essentially stepped in to pay their own citizens the guaranteed minimums, but then they turned right around and handed a multi-billion-dollar bill to Iceland. They demanded that the Icelandic state reimburse them for the evaporated savings. The geopolitical pressure was immense.
So how exactly did Iceland handle this massive fallout? Well, first, they secured a $2.1 billion bailout from the IMF just to stabilize the bleeding. Second, the government imposed incredibly strict capital controls to prevent any more foreign currency from fleeing the country. But honestly, the most fascinating step was the public's reaction. In the years following, Icelandic citizens took to the streets. The government collapsed, and through multiple national referendums, the people fiercely voted no. They absolutely refused to let taxpayer money be used to pay off the massive debts created by the reckless expansion of a few private billionaire bankers.
Section 5. A surprising recovery.
Given the absolute ruin they faced, the astronomical debt, the currency crash, the diplomatic warfare, and the public refusal to pay, you would probably expect decades of dark economic depression. But if we look at these recovery metrics, by 2015, Iceland was booming again. How? Well, ironically, the catastrophic collapse of their currency, the krona, actually ended up saving them. Because their currency was so incredibly weak, Icelandic exports became super cheap for the rest of the world. And more importantly, it turned the country into a highly affordable, highly attractive destination for global tourists. By 2015, unemployment had dropped back down to 3.8%, and GDP growth surged to 4.1%, making it one of the top-performing economies in all of Europe. They quite literally grew their way out of the abyss.
And what about that bitter diplomatic war with the UK and the Netherlands? Remember how the Icelandic public refused to pay the bill? Well, the twist here is that the British and Dutch governments did eventually get 100% of their money back. But notice the breakdown on this chart. Exactly 0% of that money came from the Icelandic taxpayer. Over the years, the receivers managing the remains of the dead banks systematically hunted down and liquidated the bank's old corporate assets and loan portfolios. They managed to scavenge enough from the wreckage of the banks themselves to fully repay the foreign deposit guarantees.
The story of the Icelandic banking collapse is a literal masterclass in the dangers of out-of-control leverage, rapid deregulation, and the dangerous illusion of infinite liquidity. A nation let its financial sector grow so incredibly massive that it eclipsed the sovereign state itself, creating a monster that just couldn't be tamed or saved when the global credit markets froze. And it leaves us with one final provocative question to think about. As global financial institutions continue to grow larger and more complex today, are our modern banking systems truly safe from the sheer weight of their own success? Or are they just waiting for the credit markets to freeze again? Thanks for joining me on this explainer, and keep questioning the numbers.